experienced in the last 9 months and what we would probably see in the near term as market drivers. Okay, the BSP. I think over the last few months, there has been a lot of skepticism on how the BSP has been addressing concerns on inflation and how they are doing their adjustment on policy rates at the moment. And clearly, the BSP has stepped up its game and become more hawkish, or they became more aggressive in increasing interest rates. And this has regained back confidence in the institution, how they are in control of inflation and on interest rates. And we have seen this, in fact, over the last few months, particularly July, August, when we saw the equity market attempting to rally back up to 8,000. I think there were some foreign funds started buying Philippine equities. Fortunately, the buying was overwhelmed by more selling in the market. And I'll discuss that in detail in the next few slides. The tax package 2, or the trabajo law. This is something that we are watching out for on how this will shape up. And clearly, this is quite instrumental, for one, on how it will change taxation on BPOs, and as well as, or more importantly, how the government can generate more revenues to support their massive infrastructure plans. And that is something that we are all looking forward to. And last positive is equity valuations are really attractive at the moment. I'll show a slide later on why we think so. However, we have to look at the negatives as well. Inflation is something that is quite alarming, and everybody is feeling inflation at the moment. From vegetables to the price of oil, up to the price of Starbucks. I think recently they adjusted the prices of coffee, I think starting Monday. So everybody now is really affected by this inflation. And it's not just a figure now, it's something that we're feeling. So it's something that we really need to focus on. And the higher inflation has really been slowing down expectations of GDP growth. And this has been really evident on the second quarter GDP, where it went down from way disappointing number of 6%, where everyone was expecting about 6.4 to 6.5% GDP. And clearly one of the culprits was consumption. It went down a bit. And it comprises about 2/3 of our GDP. And for the equity market, even if valuations are historic lows or very attractive, the bottom line is we need to see companies earn and grow their earnings. And at the moment, we're only looking at about 5.5% earnings growth for at least the first half of the year, versus consensus view of about 10 to 12%. So clearly that has translated in valuations in the market at the moment, where we see the PSCI correcting. In previous years, we have been seeing growth steadily on bottom line earnings of companies, but I think a lot of this has to do with higher raw materials and slower demand overall. Okay, let's start with the US, and this has triggered the big change in why we are on different times at the moment. Remember 10 years ago when the US was in a global financial crisis and they instigated this quantitative easing measures. And now, after 10 years or so, they are starting to do the reverse. Whereas they've been injecting the economy with liquidity, with cash, right now it is being reversed. And not only the US that's feeling it, It's the ones that where the recipients of the cash are now experiencing a reverse, meaning a lot of the funds that were created back then were starting to go back to the US because the US is now increasing interest rates and trying to curb the excess liquidity in the system. So that started the correction. It started when the US decided that their growth and inflation targets are on track. That's why they decided to slowly increase their interest rates. Because if they don't do so, they will just implode and just inject more liquidity in the system. But the good thing is, the economy in the US is very strong, and most of the countries usually have a very high correlation in terms of markets, at least, with the US. But clearly, emerging markets, as of the last few months, decoupled from the developed markets, particularly the US, in terms of the direction of market movement. And we continue to see the US market with their interest rate increases to continue because their economy will continue to be very strong. And this is why the reversal from emerging market funds moving out towards the US back to developed markets. And it definitely has made markets correct, not only the Philippines, but across emerging markets. Okay, next slide is, so as the US started increasing rates, of course, we need to follow suit. And we've seen the peso yield curve or government bond yields move up significantly. From before, our problem was we were not getting high interest rates. Now, I think we are feeling the higher interest rates across all the tenor buckets, from the short term to the longer term, 20 years. And the BSP has even added to this because we have been experiencing inflation going above our expectations. That's why the BSP became aggressive. At the start, what they were saying is that the trade law was just transitory in how it will affect inflation. But what they did not see was higher world oil prices and the depreciating peso against the US dollar. That added to inflation. That's why they changed their stance and became more hawkish or became more aggressive in increasing interest rates. So as they increased the short-term rates, the longer-term rates even moved higher as well. And at first, it was just a reaction to adjustment in US interest rates, but because of higher inflation in the Philippines, it even extended higher than forecast on adjustment in interest rates. This is why we have been seeing some shifts from investors looking at fixed income now than equities, because we have been seeing attractive interest rates from other alternative products. And the question is, will interest rates continue to move higher from where it is at the moment? And there are two dynamics to interest rates. One, in the short end, overnight rate, which is controlled by the BSP. This usually is a mechanism in order to control inflation. However, on the other side, on the long end, it is more of a function of supply. Meaning, will the government borrow more to fund for their infrastructure projects? That's why I mentioned a while ago that the train law or the trabajo law is quite important, because it will be a source of additional funding for government to fund their infrastructure project. But if the budget deficit continues to balloon and they don't have any source of funding, what the government will do is to borrow more, which in fact, will drive long-term interest rates higher. And we have all, because of this, we have seen most companies shy away from borrowing in the market because they were shocked to see that before they used to be easy to borrow and fund for their massive expansion. Now, because of higher rates, they're shying away and trying to be on the sidelines first and see how where interest rates will settle before they start borrowing for their own expansion. Again, that's why as interest rates start increasing, it will be more difficult for companies to fund for their expansion programs as well because it will be very expensive. So this is something that we need to watch out for as well. Although in the short end, it can control inflation, and we expect inflation to normalize probably by next year. But on the long end, as the government ramps up their infrastructure, then this might still be pressured. Okay. Next, inflation. This is the number one problem at the moment. I think that the government is really focusing. Last week, the BSP again raised their policy rates or their overnight rates by 50 basis points. At the start of the year, most of the economists are just forecasting 50 basis point increase in policy rates. But as of last September, the BSP has already increased their policy rates by 150 basis points. So they became more hawkish because of inflation. But if you look at inflation, it has also eaten up on growth. That's why second quarter GDP, we have seen it adjust lower to 6%, whereas nobody saw a 6% second quarter GDP because we were all banking on a strong consumption together with government spending, which is good, continues to be a double-digit growth, which I think the government, we had to hand it over to the government. Now, they're deploying their budget because the previous administration was being criticized that they were not deploying the funds. Now, we have been seeing that the government is really deploying the budget for infrastructure, and we have been feeling this more in the provinces. And more importantly, investments. We have been seeing more and more investments or capital formation in reinvesting in the economy by the private sector. So these two things contributed strongly if you dissect GDP, but it was just the consumption that was probably sidelined by higher inflation that brought down the GDP average. But the 6%, we have to look beyond the numbers because the more important thing is government spending is strong and investments is strong, growing 12% and almost 21% respectively.